Today, I'm going to walk you through the #1 tax strategy for real estate investors. And the crazy part about it is your accountant may not have heard of it or even recommend it. I'm Ken Fitzpatrick, and I've been helping entrepreneurs, business owners, and real estate investors, you name it, for over 35 years. And this is one of my favorite strategies to talk to my clients about. It's called cost segregation. All right, I'm going to walk you through exactly what we're talking about with cost segregation and why this is so important for investment real estate owners. So at the top here, if I have a property, the property is going to either be classified one of two things. It's going to be residential, so think of multifamily, student housing, senior housing, or it's going to be non-residential. Think of a triple net lease or a storage facility or data center. So the difference is that if I have a residential asset, then I have a 27.5-year life expectancy for makers, for depreciation purposes for the IRS. If it's non-residential, then it's a 39-year cycle. So that property is really broken up into two elements. So on the left, we have land, and then on the right, we have the actual structure itself. And what I would say is that a lot of times people stop right there and they say, hey, listen, I've got $1 million property, 200,000 of it is land. Land's not depreciable, so I've got 800,000 that I can depreciate over either 27.5 years or 39 years. Well, what a cost segregation will do is take that a step further. So on the land side, we really have two pieces here. So we have land, which again is not depreciable, but we also have improvements to the land. So if you think about, and this is what's deemed as 1245 property. So if you went to a multifamily rental property, there's a paved driveway, there's a walkway, there's landscaping, there's lighting, there's system elements that would have, let's say, a 15-year life expectancy, which is depreciable. So that's 1245 property, 1245 personal property. The structure itself can also be broken out further, where maybe I have the structure, and then that's going to either be depreciated over the 27.5 or the 39-year period. But what I also have is I have personal property, which is considered also 1245 property. So this is just to geek out a little bit. So this is 1250 property for IRS purposes. Personal property is 1245. So think of things like alarm systems or carpeting or things that are permanently attached to the building that may have either a 5, 7, or 15-year life expectancy. And that's the thing that a tax engineer is going to break down those elements specifically. And then the improvements to land are considered 15-year property. So that's 1245. All right, so let's walk through an actual example just so this makes a little bit more sense. So let's say that I have a $1 million building, and for this example, I'm going to make this a commercial building with a 39-year life expectancy from the IRS tables. So let's say that $800K is the building itself, and maybe in this example, we're going to have $200K as land. So if I break that out, I don't depreciate the land, but I take $800K divided by 39 is going to give us $20,512 per year. Versus if we did a cost segregation and we took that same exact $1 million asset, but now this time through a cost segregation study, let's say that the land in this example remains the same, although we can do improvements to land. But let's say that there's elements in this property that are 5, 7, or 15 years. So again, think of things like carpet and built-in alarm systems, or an attached Wolf stove, or something that is permanently affixed to the structure, but it's not the structure itself. Those have shorter life expectancies. So that would mean that the actual property itself, the structure, is at $560,000. So if I add this all up for you, I'd have the building itself, $560,000 divided by 39 years would be $14,358 per year. But then I have this 5, 7, or 15-year property that in this example, we're going to allocate the balance, the 240K to make our math work. So 240K times 100% bonus depreciation is still 240K. Okay, so our new sum total is 254,358. So I have a $254,000 deduction versus a $20,500 deduction. And even though our annual deduction is dropping from 20 to 14, it's time value of money, and I'm using this supercharged deduction for the 240,000 for the elements that I can move into this 5, 7, or 15-year property. So pretty powerful deduction. I can really take advantage of that as a massive deduction for my 1040. Okay, so your accountant is probably going to tell you that you can't deduct taxes from your W-2, your 1099, or business income from your piece of real estate. Well, they're not wrong, but what if I told you there is a way that you can do this? There are 2 exceptions where cost segregation can actually offset non-passive income. The first exception is qualifying for real estate professional status, or REPS. To qualify for REPS, you must meet both the following IRS requirements. Number 1, you have to spend more than half of your working time in real property, trade, or businesses in which you materially participate, which I'll get into in just a second. Number 2, you have to perform more than 750 hours of services during the tax year in real property, trade, or businesses in which you materially participate. To meet these requirements, you or your spouse have to be involved in development, redevelopment, construction, reconstruction, acquisition, rental, operations, management, leasing, or brokerage of real estate. Now, like what I mentioned a minute ago, you have to materially participate in order to qualify for REPS status. This means being involved in the operation of the activity on a regular, continuous, and substantial basis. The IRS provides 7 different tests to determine material participation. Here are the 7 tests. Feel free to pause this video to read through them. The second exception is the short-term rental loophole, or STR. This is a strategy where an investor can use short-term rental properties with an average stay of 7 days or less, think of like an Airbnb, to be able to use cost segregation. This is because the IRS doesn't treat those properties as rental real estate, so the activity is considered active when you materially participate. And there you have it. I hope you learned something here. It's a pretty complex topic, but if you're able to use this strategy, you can potentially save hundreds of thousands of dollars in taxes that can now be used towards maybe buying another investment property. With that being said, if you came out of this wanting to use this strategy for yourself and you have no idea where to get started, you can book a call with me or my team using the link below. We'll talk you through your situation and how this strategy can be of use to you and your property. Thanks for watching, and I'll see you on the next one.